Yield curve analysis. What is flattening? Mikey, go. What is yield curve flattening?
Oh my gosh, it's when the spread between different duration interest rates narrows and becomes tighter so that the yield curve, when it's normally upward sloping, is actually flat. The rates on 2, 10, and 30-year rates are about the same. That's a flat yield curve.
We don't even need to do the segment. That was perfect. Maybe a little too fast for people, so we will do the segment and elaborate a little bit. But I know a lot of people with the Fed coming out and they're moving interest rates around. We saw an inversion a couple of weeks ago between the 2-year and the 10-year interest rate. I love to jump on here and do some analysis, define what flattening is, look at it both theoretically and then look at it practically given today's prices in the yield curve, and help flesh this out a little bit for people. If you have any questions on flattening or the yield curve, you can always reach out to me at Frank_Caberna on Twitter. And also don't forget to, subscribe to the Small Exchange YouTube channel and leave some comments or your answer to today's question or further questions on today's topic in the comments there. We are very adamant on the Small Exchange YouTube of answering everybody's questions, but let's dive into it and hopefully answer those questions right off the bat. This is what a normal yield curve looks like, Mikey. Maybe you can elaborate on what we're looking at with the 2-year, 10-year, and 30-year major benchmarks for any yield curve, whether it's the US, Japan, Germany, wherever. Today we're looking at the US, but maybe let people know why this thing is upward sloping, what upward sloping means, and just give people the full spiel on normal yield curves.
Sure, happy to. So these are Treasury yield curves we're talking about, the US Treasury yield curve. Basically, the government needs to borrow money. They need to sell bonds. That's how they do so. And they offer them in a number of different durations, we call them. 2 years, 10 years, 30 years. That's how long the bond or fixed income instrument will last. And the government will pay you a different interest rate depending on how long you lend them money for. So they offer these different tenors, 2, 10, and 30-year. And generally, the longer the duration, the more time the person has to hold the bond, the higher interest rate the government will pay them to hold that, because there is some risk, right? The longer you're holding some bond, the more things can happen and markets can change. So they want to compensate you for that. And thusly, 2 years are generally lower than 10 years. And 10-year interest rates are generally lower than 30 years. So it's kind of like this time value of money concept. The longer you hold the money, the higher the rate should be.
Absolutely right. And great definitions there and great example, but also know that where these interest rates are in terms of the US Treasury dictates a lot of your practical uses of interest rates as well. Like if you have a short-term car loan for 2, 5, 10 years, then that's going to relate to this U.S. Treasury yield in that same time frame. If it's a 30-year mortgage, it's going to translate to the benchmark that's being set here in that 30-year time frame. Now, with that being said, this is what a flat yield curve looks like, Mikey, and I'll take this one. And you can see why it's called flat, because these 3 different parts of the curve are now they've converged to being flat. And basically, when people say, oh, the yield curve is flattened or we're seeing flattening, they're saying that interest rates between the 2-year, the 10-year, and the 30-year are coming close together. They're flattening out there, where normally, like Mikey spoke to, the greater time, the greater the yield. And so we'll see this environment sometimes, and we're actually seeing it a little bit right now. We're not completely flat, but that current yield curve, you can see 2 years are around 2.5%, 10 years are around 3%, and 30 years are around 3%. And so relatively speaking, very, very flat in this yield curve. And this is translating not only to some awkwardness in the macro economy. And a lot of people talk about, a flat yield curve being a sign of stock market turbulence and everything else. But I want to end with a practical trade for a flat yield curve, because as you might imagine, Mikey, we tend to be in a normal yield curve environment. That's why it's called normal. But now that we're in this flat yield curve environment, you can actually not only read about it and talk about it and let your friends know over the weekend, I learned about what a flat yield curve is, but you can actually trade it with something like the NOB spread. Maybe you can close out our show with a quick talk of what we're looking at here in this spread market chart.
Sure. So this is a different way to visualize kind of the animated pictures we showed on the previous slide. Here we're looking at the actual difference, kind of the nominal difference between that 30-year interest rate and that 10-year interest rate. And when it cascades downward from 8 to 2, that is the same as the yield curve kind of flattening, getting closer and closer together. And the way you can trade this is very simply going to your platform and buying or selling those individual legs, those 2-year interest rates or those 30-year interest rates. So for example, if you looked at this chart and thought, wow, this thing looks really cheap, maybe it's actually going to go higher, the way you would do so is you would sell the front month, the 10-year interest rate, and you would buy the back month, that 30-year interest rate, and make money if the difference increases, if that yield curve comes back to a normal structure whereby 30-year rates are trading higher than 10-year interest rates. Pretty cool that you can actually go to your platform and trade something as ubiquitous as the yield curve right now, because you couldn't do something like this just a few years ago. It's really exciting.
Absolutely, my friend. Couldn't have said it better myself. Thanks so much, Mikey, for all your great words on yield curve flattening. We didn't even get to talk crypto today, which is Mikey's bread and butter, but we will next week. I'm sure it'll be another volatile weekend and week for crypto. But there's your yield curve flattening. There's your full week of small exchange content and trading, everybody. Thanks so much for joining us. As always, Splash into Futures is coming up next. Have a great and safe weekend, everybody. Peace.